Good morning, and welcome to the weekly mortgage market update with David Luna and special guests. Please let me introduce the president of CAMP, Ms. Audrey Boissonneau.
Good morning, everyone. Thank you, Megan. Thank you so much for joining us. I'd just like to say thank you to Megan Jackson, as always, who is the person who makes this all happen, Kevin Casey, who is CAMP's president-elect, Dave Luna, of course, and our special guest, who we'll announce later. Just a few notes as to what's coming up next. So tomorrow we have Megan Anderson, who will be joining us to go over social media. We have a snazzy title, which escapes me at the moment. So basically it is planning your marketing for the virtual future. Then on the 28th, we have our NMLS 8-hour continuing ed class with Kevin Casey through Mortgage Educators. So make sure you sign up for that. And also note that when you're doing your registration, go to the drop down and pick the chapter that you belong to and click on that, and then the credit will go to them. Then next week on June 7th, we're going to have our usual mortgage market update at 11 a.m. June 3rd, I'm very excited to say that we are having finally our credit and COVID webinar. It's with John Arcali and Terry Clemens. So John is with FICO. Terry Clemens runs a credit reporting association. They are both incredibly knowledgeable, and you will not want to miss this. It'll be very, very interesting. June 4th, that's the following Thursday, we're going to have another Camp Social Hour. It was a huge success, and we've decided that we're going to add a brainstorming session to it. So we will have sponsors who will, well, sponsors may be the wrong word, but we will have people who will be presenting different programs that exist right now that might help your business, and bring a drink. Your drink of choice could be Pellegrino, could be a shot, your choice. And I just want to remind everyone to please become a member of CAMP. It's really important. Our organization is run by volunteers. It's a very grassroots effort sort of situation, and we really need your support. So please go to www.thecampsite.org and join today, or renew your membership if you haven't already. And also just a reminder that during the webinar, you are more than welcome to put your questions in the text box or the chat box, and we'll get to them. So with no further ado, Dave Luna, what has happened in the last week since we've seen you?
Well, let's talk about what's happened. So from our last visit, this is your update for the week. And I haven't done anything that tells you what's going to happen like 3, 4, 5 years out. So I'm going to do that today. So this past weekend, Federal Reserve Chairman Jerome Powell reaffirmed his commitment to use the full arsenal of monetary tools to support the U.S. economy in whatever way is needed. Because again, with rates where they are, what else can he do? Okay. So this may have been a reference to the stimulus package passed by the House last week, but may not see the light of day until next week in the Senate. There's hope maybe for another stimulus package, where he said we need some more stimulus, but let's see what happens. It gave stock investors the boost of confidence they needed. So you should have seen that rise last week, but then, it kind of slid down as the US and China are kind of, positioning, themselves and what the heck they're going to do. So for conventional conforming loans, there's no wait to buy a home or refinance. We know that there is now a 3-month wait period. If your borrower didn't make payments while in forbearance, those who paused payments must make 3 consecutive mortgage payments after forbearance ends to be eligible for a new home loan. So the 3-month waiting period is much better than the 12 months we saw before. So remember last week we talked about non-QM coming back, and we had the guest people on non-QM. Well, we're starting to see jumbos come back, and that's why we have our special guests. Andrew, I don't know if you're this way or that way to me, but anyway, we've got Andrew coming up. This is what caught my attention, and then Audrey and I started talking about their new jumbo program featuring an LTV up to 90%, minimum credit score of 660, a 43% back-end DTI, and loan amounts. You're going to love this, Kevin and Audrey, seeing that you're in Northern Cal. Loan amounts up to $3 million, and borrowers are not required to obtain private MI. So, Andrew, we're going to kick it to you in just a second. Programs are starting to come back into the market. FHA director still has his focus on taking Fannie and Freddie out of their 12-year conservatorship. He said the exit has only been delayed a few months, so we'll see what happens. So as I mentioned last week, when the reoffering, because it's not an IPO, when the reoffering does come out, it will be the biggest ever in the history of the country. The main problem on the horizon is what will the loans in forbearance do to the value if the GSEs have those on their books. Now, Dr. Calabria feels that less than 5% will need any kind of forbearance loan mod. We'll see what happens. Speaking of forbearance, on May 19th, Forbes kicked out an article that said of the 4 million loans in forbearance, almost 3 million said, didn't need it. And they were just not sure what was going to happen in the future, so they just took advantage of the opportunity. 38.6 million people have lost their jobs since mid-March. This number hopefully will slow and hit its max by July. So we're not watching any more initial jobless claims. What we're watching is continuing unemployment claims, and that'll tell us how many are still out of work. So because I like telling you about things to come in the future, I want you guys to remember May 26, 2020, Dave told us this. I'm telling you, and I hope I'm really close on this one, it's about 3 to 5 years out. The plan for Fannie and Freddie's director to bring the GSEs out of conservatorship, remember how we've been talking about that? Fannie and Freddie need capital. Today they've got about 45 billion, which they've saved over the last little bit. They're working on having between 200 to 240 billion, which is why it will take 3 to 5 years. Now, the reason for the moving target is like, Dave, couldn't you tighten that up a little bit more? It's that what will revenues be over this year and next year as the economy gets back on track, and the revenue that they're going to generate from the trillions of dollars of loans we're all going to be doing. That will determine what happens in 2020, 21, and maybe even into 2022. So the real question is, why does the GSE need money? The answer is what FHFA director said last Thursday. He said, quote, together, the enhancements in the re-proposal ensure each enterprise's safety and soundness and its ability to fulfill its statutory mission across the economic cycle, in particular during periods of financial stress, end quote. Do we all feel that we have endured a period of financial stress? I'd say yes. So what the FHA is thinking is, how do we make sure the GSEs are strong enough to endure financial stress when they're out of the sheltering umbrella of the U.S. Government? The best way to stress test: cash, capital, assets, right? So what this will do is create a huge financial demand for their stock. It'll help it accumulate the capital it needs to exit from conservatorship. So think about it. The income that they're making right now and all the refi income they're going to make, their G fees and their stock combined will be enough to pull it out so it'll never have to be bailed out by a taxpayer again. Guys, how much money will they make? I think they're going to make a boatload of money in 2020 and 2021, but at 2022, 23, I'm not exactly sure where that's going to be. So speaking of income, the volumes going through our pipelines right now are absolutely full of profit. According to IMF News, for the past 35 years, industry has enjoyed a pre-tax profit of 35 to 50 basis points on production. Today, it's between 50 to 80 basis points is what they're making. CFPB has not been idle. Friday, right before the weekend, they filed suit against a credit repair telemarketing company in Massachusetts. So from 2016 to 2019, Key Credit Repair enrolled nearly 40,000 consumers nationwide. And since 2011, it collected at least $23 million in fees. The Bureau says it violated the Consumer Financial Protection Act's and telemarketing sales rule prohibitions on deceptive and abusive telemarketing acts. They filed in federal district court that they deceptively misrepresented what the company could do when they says, oh yeah, we can increase your score and we can get rid of the negative stuff. they're saying that they didn't achieve those results. Ladies and gentlemen, before we meet again, LIBOR's going away. So new language is required on June 1 regarding ARMs that use LIBOR as an index. If you're using LIBOR, it's got to be on your application dated before September 30th because GSEs will no longer take ARMs with LIBOR indexes after December 31st. So the new SOFR index will replace LIBOR, and that's what Mr. Kevin Casey will talk to you about in just 2 days. Reports to watch. California first, AB 2501 passed the Assembly Banking Committee, now goes to the Appropriations Committee. We don't know what it's going to look like after it gets through the legislature with, you know, everybody's amendments and stuff like that. But the key part is a 1-year forbearance on mortgages. Madam President, you and I were talking before this thing started about what they're trying to fix a problem that's not a problem anymore. Isn't that what we were saying? Okay, she's not going to say anything. All right, today we've got a lot of housing data that's going to come out. The Standard & Poor Case-Shiller Home Price Index, consumer confidence, new home sales. That's today. Then on Thursday, initial weekly jobless claims, gross domestic product, pending home sales. On Friday, consumer sentiment, personal income and spending, and core PCE. You guys don't know what PCE is. Personal consumption expenditures, not food and gas, but what are, you know, people paying for things. And what we're really watching is inflation. One of you guys asked me a question about, Dave, where do you see inflation? The Federal Reserve is trying to keep it at 2%. Right now, it's at 1.7. It's actually down from 1.8. That finishes my report. And now our special guest, wherever he's at. I don't know where you are, Andrew. I don't know if you're to my left or to my right, above or below. I don't know. It's like that Brady Bunch thing. I don't know where you are, sir.
Oh, and what they do is they reverse the screen. I'm looking at my left and my right is all mixed up when you're on video.
Okay, you guys need to stop pointing at things. It's freaking me out, okay? No more pointing.
I'm probably
everyone's going the wrong direction.
Yeah,
okay,
but
so
when we talk about that jumbo lender, I know there was some people that went, what? You know, 660, 43%, 90% LTV, up to 3 million. And with that, Madam President, I turn over the introduction to you.
So I just want to say thank you, Dave Luna. That was great. And as always, please send in your questions. When David and I were having a conversation about what we were going to talk about this week, he mentioned that he knew about this lender who was doing jumbo loans at 90%. So we thought we'd pop them in here today because I know we're all looking for alternatives to replace what we had lost a couple of months ago. And so this will just be a brief overview, and then you'll be welcome. You're obviously welcome to reach out to them directly for your scenarios, etc. But I'd like to introduce Andrew Connor. He is with Sprout Mortgage, and he is going to share with us a little bit of what they are doing. So Andrew, thank you for joining us today, and take it from there.
Thank you very much. Hey, Dave, man, that was good information. Really appreciate that. I even took some notes, as you can see. I take notes all the time. Folks, I know it's hard to look at a matrix in your head because we don't have something. If you got a paper and pen to jot down some notes on this, just to give you an idea of, here's where the guidelines are, FICO, LTV, because that's all I'm going to do. Just take a few minutes and look at the matrix. I'm going to actually read right off of the matrix because it's a brand new product and I'm still learning it. It's that new. So in a nutshell, here we go. Ready? It's called the Premier Jumbo Full Doc. Okay, it's only for 30 years. They only
Andrew's gone. Uh-oh. Oh, no.
Andrew. Okay.
We had to get Andrew from Missouri. Wait. I think he's coming back.
Andrew,
so fuzzy. Wi-Fi decided.
Andrew, we're gonna give Andrew a moment to get his audio video together. And just say that when he was going through those different guidelines and those different options, he had mentioned to me the other day that you can't have 90% plus, like you can't have everything. So you're definitely going to want to run your scenario by whomever your rep is. Andrew, we're starting to see movement again, but we can't hear you.
Okay, sorry folks. Hey,
there we go.
Where did I
Okay.
leave off? I apologize. That was weird,
That's the last thing we heard.
Okay,
The
so
what?
speak quickly, just in case we lose you again. Speak quickly. We heard that you are learning the guidelines. Now go.
Oh, okay. So here we go. 30-year fixed is all they offer on this. Is a 30-year fixed. So the combination of you want that 80%, you have to go with I'm sorry, 90% LTV is a 700 FICO. So you need a minimum of a 700, which is great. You can do the program to 660, but it's at 80. So here we go, 700 to 90 LTV up to $1 million. And then if you do want that 3 million that Dave was talking about, you will need a 740. However, 720 gets you 2.5 million, but 740 at 3 million is also only 70 LTV. So the lower the loan amount, then you raise your LTV a little bit. Okay, so make it clear, 90 LTV is a 700 FICO up to $1 million. If you want 2.5 million, you can go to 75 with a 720. And if you want that 3 million, you got it. It'll be down at 70 LTV with a 740. Now, for those that just want a little extra 5%, you can get a 680 FICO with an 85 LTV up to $1.5 million. And we will do 660, as David mentioned, but down to 80 LTV up to $1 million. And folks, cash out to 75 at a 700 and 680 to 80. Cash out on a jumbo to 80, but that's only at $1 million. Okay, with 680, you need $1.5 million for 75. So it's the same as it is above with the 700 minimum for the higher loan amount. So 680 to 80 on a cash out. They'll do second homes, they'll do investment properties, and by the way, they'll do cash out on the second home as well. And are you ready for this? Cash out on the investor. On non-owner occupied, they'll do cash out. So you need a 700 minimum for the cash out, and that's the 60 LTV, but get a load of this. 75 LTV, 700 FICO, non-owner occupied. There we go. Now, some other things. Again, reminder, 660 minimum FICO. Did you say something, Dave?
Really good info. Are you going to throw in interest rates either at the credit scores or LTVs? You're going to throw that
in? I'll cover that a little bit at the end because I have a rate sheet over here open. I did have that prepared, but let's see where it goes. So 43 DTI as
Andrew,
yes?
I just want to state for people who logged in late, they want to know who you're with. This is Sprout Mortgage. They have reps in California, and we'll make sure that we send the information out after the webinar so that they're able to connect with whomever they need to connect with in California. Correct, Andrew?
That is correct.
Great. If it's somebody else, then yeah, it's great. And do you have a minimum loan amount, by the way, on this program?
Yeah, it's $1 over the 510 400. $1 over.
Got it.
So it's jumbo product specifically. And okay, so I was at great LTVs, very aggressive LTVs, including cash out and even cash out all the way down on investor products as well. Remember, 660 minimum score to 80 LTV, that's pretty good. DTI is 43, and if you're greater than 85, so the 90 requires the 40, as David said. And let's see, a few other points. Oh, you will need reserves. I'm not going to get into the minutia with that, but 6 months, 9 months, 12 months, depending on your LTV. And of course, if you have, additional properties and investors, then you'll need reserves to cover those as well. So reserves, don't forget about that requirement. There will be on that. All 50 states, yay, yippee, no exclusions. I do know that there are some products, and even that Sprout had that might have restricted certain states. This has all 50 states. That's great. And now, no foreclosure, no bankruptcy or anything like that in the last 7 years. So we are talking about a prime borrower here. 0 times 30 in the last 6 months, 1 times 30 in the last 24. So we are, again, perfect in the credit sphere. Although FICO could be lower, but maybe they got debts or something and they're just dragging their score down, but not because of any late payments. But that's mortgage and rental history. So if they have lates on a credit card, that's just going to be already figured into their score. So keep that in mind. And then let's see what else we've got. Appraisal, 2 appraisals if you're $1.5 million or more, okay, or over $1.5 million. I mean, two appraisals for over $1.5 million. That's kind of important to ask. And let's just make sure I covered everything. Does anybody need me to requote those LTVs? Oh, there is a cash out. If you do cash out, if it's greater than 50 LTV, it'll be $350 cash in hand. And if it's less than 50, it can be $500 cash in hand. You know, the little caveats, just trying to give you as much detail on this specific program. Any questions on that, Dave? Did I highlight everything that you thought of when you heard about it?
Well, when Audrey talked about, latecomers coming in and we were having those little technical, glitches, I'm wondering if you might want to repeat that first part again. Again, Andrew, Sprout, just very, very quickly, the overview, and then if we have some specific questions, we could drill down into specific answers. So just one more time for all the latecomers and stuff, very, very quick overview.
Okay, sure thing. Yeah, all right, no problem. 30-year fixed. Sprout Mortgage has a premier jumbo full doc, 30-year fixed only, and they'll go down to a 90 LTV, as high as a 90 LTV with a 700 minimum FICO to 1 million. If you want a higher loan amount, 720 FICO, 75 LTV, 2.5 million. And then the next one up would be 740, 70 LTV to 3 million. So that's the general on the primary or owner occupied. We will go down to 660 with an 80 LTV to 1 million. That's incredible right there. 660 with an 80 LTV to 1 million. I like that. I mean, that's incredible. So, okay, and then so we'll do cash out. Go ahead.
We do have some questions. So what's your max DTI?
Max DTI on this is 43 DTI.
Okay. All right, great. And do you do correspondent and broker or just one or the other?
Yes. We do both, and this product is eligible for both.
Okay. And then what are the rate ranges? Don't give us scenario range. Just give us a range on this program.
Today, and that is a good question in regards that I'm seeing in the 4s, the upper 4s, the mid to upper 4s. It will be borrower paid. Okay, it will have to be a borrower paid, or you'll have to charge points to make any money. That's just the way this stuff is.
That gives us an idea. So that's great. And then on the 2 appraisals, do you have an approved appraiser list? How does that work?
Yes, Sprout has 3 appraisers. So when you submit your loan, you will order your appraisals right off the website it'll link you to one of our 3 AMCs that we use. But we will take a transferred appraisal if you do have something, as long as it followed HVCC and what have you.
And the appraisal trigger, second appraisal, that is loan amount over 1.5 or value over 1.5?
Good question. Let me look. It says loan amount.
Yeah.
Loan amount.
Okay, so there's another question, and actually, David, let's talk about this, in general, not just in relation to Sprout, because we have a comment from somebody saying that they started the broker package with Sprout, but they can't get over the 12-month DPO policy. So there's a 12-month DPO, which also includes an extra $1,200 fee. So this is not the first time I'm hearing 12-month EPO, and David, you and I have talked about this, because I feel like if there's an EPO, maybe there should be a prepay penalty. So the borrower's agreeing to and participating in a commitment to a 30-year fixed mortgage that they are doing. So Andrew, is a 12-month EPO standard for Sprout? Is that a new thing? And yeah, talk about that a little bit, please. And then Dave, jump right in.
The EPO has been our broker agreement, if you will, broker, correspondent, whatever, has been the same for the last couple of years. So it's not something new, although it may be something that's newly being circulated. It kind of is what it is when you're in this space, the non-QM space being a little different. And I know there may be other non-QM lenders even that did not have that, but I know there may not be as many non-QM lenders in this space since the changes, but
so that's
it also depends on the relationship, I think.
I'm going to put you out of your misery right now. You don't have to like talk about this anymore because anyway, but David, I would like to talk about this a little more because again, it is based on what we've all gone through in the last 3 months. I mean, maybe it's a conversation we should be having. Should we have an EPO that matches a prepay penalty? Like, what do we?
Yeah, to what Audrey is if the loan officers, if all of us, if industry is going to get spanked with an early payoff, shouldn't the borrowers have some participation in that as well? So Audrey is suggesting, well, why can't we have like a 1-year prepay? And Audrey, I don't want to put words in your mouth, but to the same dollar amount as whatever the early payoff is. It's not that the loan officer is trying to become enriched, you know, and we understand that the lender needs to make a profit, and we understand that the lender is putting forth their profit first to pay us, and they hope that they'll get it over the next 6 months, or in Sprout's case, 12 months, you know, whatever. So yeah, see, the thing is, if we do a prepayment penalty, nobody anywhere in the industry is doing a prepayment penalty. And I don't know that the borrowers would go for it. I understand what you're saying, Madam President, but I just don't know the borrowers would go for it. And I don't know that, go ahead.
My feeling is just that we need to have this conversation. And it's interesting because when I speak to other LOs, some of them, you know, again, we've even talked about maybe a gentleman's agreement or whatever you call the women included agreement, that would say that you just agree that you're going to subscribe to the idea that you're not going to do a loan for somebody who's done one in the last 6 months, year, whatever. With that being said, I have a friend who thinks that it's fair game, no matter what. He's a good guy. So I know that I think that this conversation is starting to happen. I'm starting to see it pop up more and more. I've been talking about it for a couple of years because I just think it's unfair that a loan officer should have to bear the entire brunt of a borrower who may or may not have even gone back to them to refinance, and they have no ability to stop or control what the borrower's doing. Why are they the ones who are paying the price here? With that being said, I'm talking to servicers who are saying it takes 4 years to recoup their investment when they buy a loan. So, I mean, I get it. I get that this is a very big conversation, and it will not be solved here or anytime soon, but at least I think we need to start having it because there needs to be a solution to this, as I'm hearing about more and more brokers being hit with EPOs, and we have some lenders who are contacting their brokers and saying, hey, this is a prime prospect for a refi, and then they get hit with an EPO because it was, you know, within a certain, anyway, it's complicated. I get it, but I think we should be talking about it. So let's see what else we have, Andrew, now that you're out of the hot seat. They're asking if, okay, so again, I'm going to invite everyone to contact their Sprout rep and ask for specifics on the program so we don't go through a bunch of guidelines and specific scenarios. You want me to give
my phone number?
We'll send it out to everyone. You're not the rep for California though, correct?
Well, it's open territory. You know, I happen to live in Missouri. I have clients in California. I have clients on the East Coast. I have clients in the West.
So they could contact you directly, Andrew.
Yes, I can answer their questions. And if they already have, this is very important to mention though, if you already have a rep, if you already signed up, or if you already have someone who's contacted you, please reach out to them. They are your first point of contact. But if you don't have a contact, then simply just reach out and I can either direct you or I can certainly help you.
So there's a comment here that they said, I'm all for prepays, but I thought there was a mandate that there would be no prepays. And I'm saying, yes, you're right. And I'm acknowledging that that exists. I'm also saying that just because something exists doesn't mean it shouldn't change, and that we shouldn't revisit something. And especially when we are talking about loans, we're not talking about a 3-year prepay on a 228 subprime exploding right in your hand loan that's going to take out somebody's homeownership. I'm talking about somebody just agreed to a 30-year fixed mortgage. What on earth are they thinking they're going to do in the next 6 to 12 months, right? So again, I am stirring the pot. So I apologize if that makes you uncomfortable, but I think that as an industry, based on what we have seen in the last 3 months, especially where you see all sorts of, I mean, the implications when there are the amount of early payoffs that are happening and the lowering rates all of a sudden, it's just, we need to make sure our market stays healthy. That's all. That's all. So back to forbearance, David, Luna, because we can never, ever get enough of this, can we? So can you explain how a borrower who...
I'm getting sick of forbearances, but go ahead.
They'll be over soon. Don't worry, baby.
Okay.
Didn't Mr. Calabria or Dr. Calabria indicate that he thought that the window was going to close sooner rather than later, although I think that he had mentioned the end of May, and I have heard absolutely nothing, and I think that that's probably premature. But it's going to come at some point where they're going to close the window.
Forbearance window closing either. I know we had the conversation about will it and when, but there's been no conversation, nothing. And I checked this morning, there's been no communication from Fannie, Freddie, or their regulator, FHFA, to end it or have it continue past. The only thing that I did find was things were supposed to end, May 17th, and they were extended to June 30th. So because that's the only thing I've seen or heard, I can only assume that thought process will continue, that anything that they said that would end in mid-May has now been continued to the end of June. But that's it. I haven't heard anything else. Plus, I think, like we said last week, I think that forbearance and the unemployment curve has been flattening. Yes, it went up again this week. Yes, I understand that. And yes, I feel sorry for all those people that are going through this heck that they're going through right now. But no, I haven't seen anything that says it's going to end by the end of the month. I think we got to at least June 15th to see if they've made June payments. But the good pieces are, of the 4 million that took out forbearance and the 3 million said, well, I didn't really need it. You have a lot of people that have never skipped on a payment. They haven't.
Right.
They're still making their payment every month. So
yeah, that's great.
Yeah.
I have a neighbor who stopped me this weekend and said that they had called their lender, asked about it, and when they figured out what the terms were going to look like, they're like, forget it, we're just going to make our payment. And so I think a lot of people did it thinking just in case. I'm hoping that we'll find out in the end that the number of people who are taking advantage of a situation was minimal, and we'll be able to just move on and, again, get back to at least some semblance of where we were 3 months ago. So back to the listener's question, can you explain how a borrower who inquired with his bank about forbearance but never signed up, they've never missed a payment, all the payments have been made on time, what's your opinion on this type of scenario? So my understanding is they should be able to refinance if they've never missed a payment, correct?
Correct.
Right.
So again, from the director for conventional loans, there is no wait to either buy or refi if the borrower is in a forbearance plan but continued making payments. There is no wait period. There is no 12 months. There is no 3 months. It's the 3-month waiting period if the borrower didn't make payments while in forbearance. Okay, so if they didn't, they just called, and sometimes people were put into forbearance even though they were just calling, hey, I just have a question, I've heard of this, right? And many companies just put them in forbearance just because of the volume of phone calls, but they continue making payments. there is no wait to either buy or refi.
Right. And so I think the trick is going to be the people who ended up being put into forbearance either without even requesting it, or went into forbearance but kept making their payment, and seeing how that's coded and what's happening on their credit report, which we will address next week. And we should be able to get answers on how that's really working at the bureau level, and how, because if somebody's got that on their credit report, DU is going to read it and they're going to kick it somehow. I would imagine, I'm seeing that happen, or I've heard of that happening. I see Andrew twitching. Would you like to jump in here, Andrew?
Yes, I actually do know something about on the credit. There is, just as a teaser, I don't know what you're going to have next week, but there is a code internally embedded within the credit scoring, but it's not something that affects the score. If your payments were delinquent prior to the forbearance, then you're going to have a problem with your credit. But if your payments were on time, yes, there's a code that tells it's in forbearance, but then your credit score is not affected as long as you're making the payments within the forbearance or the time frame, whatever that agreement is.
The credit score isn't affected, but your ability to get an approved eligible is impacted. So that's what we're going to talk about, is whether or not, or how, not whether or not. We know that people are getting kicked with that coding on there, even though if it says natural disaster or whatever has been coded in there. Or again, for the people who were put into forbearance without even asking to be put in forbearance. And so anyway, so there are all of those issues. So anyway, but it's all good news, right?
Right. So even those that paused in making payments, they're just as long as they make 3 consecutive monthly mortgage payments after their forbearance ends, or they thought it would end, or never asked it to start but didn't make a payment, it's just 3-month waiting period. If they wait those 3 months, they can get a mortgage even after forbearance. So if those people are in the forbearance for 3 months, April, May, June, and then in July, August, September, they make their payments, they're good to go. You can do this loan.
Right.
You can actually start in September. It won't close until, October 1, but you can help those folks. So I think the clarification that we talked about last week is super, super important. And if anybody reads Rob Chrisman, Rob did a really simple and absolutely accurate way to describe it. So a little love to Rob Chrisman. I don't know how long ago it was, 3, 4, 5 days ago. I don't remember how long it was, but his explanation of what the process they have to go through is exactly the same thing I'm telling you guys. If they never went into forbearance, or they went into forbearance and made their payments, no wait. If they paused, they didn't make a payment, they got into a forbearance plan, they are now out of it, and they make 3 payments on time, even if the forbearance plan is for a year. So we're talking like next year, like summer of next year. If they were in a forbearance plan, but they've made 3 consecutive payments in that plan, boom, they're good to go.
Right. So back to the EPO question, not that it's controversial at all. So this is the comment. The question that needs to be asked is what percentage of loans that have an EPO within the first 6 months of closing? There are 3 question marks after that. So it's a big question. Why punish all borrowers for the behavior of a few bad apples? And again, nobody's being punished. It's literally just a commitment to, I did this loan. I understand there's a cost involved, and this is what we know that we're going to agree on. So again, I know it's controversial. I know it's not solved today, and I know it's not, it's just not simple. So with that, gentlemen, we seem to be at the end of our questions, and this is good news, I have to say, because do you remember whenever we started this 250 years ago? I mean, the questions were just like on and on and on and on. And I think the fact that we have the changes that are happening now are now changes for the better, it seems. And there's less uncertainty and less questions, and that means we're headed in the right direction. So do you have any last comments, Dave Luna?
Finally.
There
you
are.
Haven't, lost for words. No, I don't really have anything to add, other than it really looks like the worst of everything is over. I know I keep hearing things about, Christmas time and whatever. No, as states, as economies start to open up, as people start going back to work, I mean, I'm seeing the Denny's and the IHOPs and, the ones that are right there along, the main streets, they're opening up. People are going, and it's not just those guys, but anyway, I'm seeing people start to go back to work. Unemployment claims have really slowed down. I think the worst is behind us. Maybe I'm over hoping, but I think the worst is behind us. There will be, unfortunately, some that will not get their jobs back. There are some landlords, commercial landlords, where companies are going, hey, wait a minute, we can do this without having a physical office. So the ramifications of what we've gone through, we're going to feel for quite a few months. But we can now find hand sanitizer in the stores, toilet paper's back. I mean, things are starting to return back to normal, the new normal, whatever that means.
I hate that term so much.
Yeah, in Florida, Universal Studios has, reopened, and parts of Disney are reopening. So, I mean, how movie theaters and everybody else is going to figure that out, I don't know yet. But again, we're starting to come out of this, and I hope that solution for the coronavirus is really more real than fake. And so if in fall, winter, next year, more realistic, we find a solution, that's when everybody's going to go, I can return to normal. So it's still going to be a process, folks. We're not out of it yet. It's going to take months. It's going to take at least a year.
Two more things popped up, David. Let's start with, and I think we know the answer to this, but let's just clarify. Does borrower need to bring the deferred payments from the forbearance current in order to refinance after they've made 3 successful monthly payments after the forbearance ends?
No. So let's say we're on this forbearance plan for a year, okay? They went from March 2020 to March 2021. Now they're out. And so all they have to do is, now we have the new plan. And the new plan is you got to pay X. And the borrower goes, okay, cool, I'm back to work, I can pay X. 3 months. All they got to do is make 3 payments, boom. And it's not like, we've all been doing this for forever. The underwriter comes back and says they got to make 3 monthly payments, and we sit there and say, well, can all 3 of them be made at once? That's not how it works. If they do 3 consecutive monthly payments after the forbearance ends, boom, purchase or refi, no problem.
And then the amount that they didn't pay, let's say they skip their 3 months payments, does that amount gets tacked on to their principal balance or the payoff?
A couple of different things. No, it's not tagged onto the principal balance, because in the CARES Act, you can't have interest on top of this. So it's just put at the end of the loan, no interest. It's just going to be part of the loan whenever that loan is paid off, then it all comes due. And so we know that most of the time people don't have their loan for 30 years. It used to be something a lot shorter, 7 years. I think now it's 9 years. But however long they have that loan, so if they refi in 2021, after making 3 consecutive monthly payments, they're done. It's good. Great question.
Okay, but again, so their 3 months payments, their monthly payment includes principal and interest, taxes, and insurance, let's say.
Right.
So that amount, that total amount, is what is included in their payoff when they go to refinance, let's say.
Correct.
Okay, thank you.
It's not forgiven, it's added on.
Correct. So they don't have to bring it. And so the answer, though, to the other part of this question is they don't have to bring it current. They don't have to come up with that money. They can tack it into their loan amount and it's still rate and term?
Yes.
Hallelujah. Okay, so they're asking if Fannie Freddie are still charging the 500 basis points for loans in forbearance. The answer is yes, right? That hasn't changed.
It's the 500, it's the 700, and unless, what we learned from Andrew today on the cash out refis, way to go, Andrew, on cash out refis. Yeah, so yes, it's either 500 or 700. You are correct.
Great. And hopefully that goes away soon. I'll be dancing in the streets when it does. And then we had a question about the new 1003. So why don't you remind us of the dates on that and how that's going to roll out?
The new 1003 has now been moved to March 2021. Nobody was anticipating COVID-19, so they moved it to March of 2021. The 1003 hasn't changed since what was going to go live. They're just giving people more time. And when we say people, it's not necessarily loan officers, but software providers and just, you know, everybody that's got to retool and get everything up to speed. March 2021. Andrew,
what was the original rollout date, David?
Do what?
What was the original rollout date on that thing?
Original?
Yeah,
or the
original. Yes.
The latest
No,
original?
the original.
Andrew, help me out on this thing. It was going to be November 1st of this year, and then
It was supposed to be 2019 originally.
Thank you.
Yeah.
That's what I was looking for.
And
Okay.
then it got pushed a whole year, November 2020.
Yeah. So now it's March
Well,
2020.
Well, we would hate to rush it, right? I mean, the suspense. I mean, what are we going to do for fun and entertainment? We don't have that to look forward to anymore, right?
Exactly.
So with that, we're going to wrap this up. I just want to remind everyone, please go to thecampsite.org and be a camp member, renew your membership, or become a camp member, and let us know if you have any questions. We'll send a link for this recording out afterwards with Andrew's contact information, or you contact your Sprout rep. And please join us for our upcoming events. We have a lot coming up, and we are really excited to have you join us. So with that, have a great week and a great rest of the month, and I will see you soon. Thank you.
Take care, everybody. Bye.
Thank you. Bye-bye.